Hello, and welcome to this special edition in which we discuss the impact of the US midterms on the US economy, policymaking, and markets. The vote has split Congress. The Democrats have secured a thin majority in the House, while the Republicans retain control of the Senate. This new balance of power will create a legislative gridlock and result in a less efficient US administration. But executive authority could assert itself more. A Democrat-led House is unlikely to overturn President Trump's signature economic policies, such as tax cuts, deregulation, and protectionism. There should be no additional tax cuts, but some bipartisan progress could be made on infrastructure spending. A split Congress should not change the dynamics of trade politics, as the Democrats are traditionally more protectionist than the Republicans, although both parties' attitude on this front have been shifting recently. This outcome should not affect the economy's cyclical strength, and investors will watch the cost of capital, inflation pressures, unemployment, housing, and trade tensions to gauge the health of US activity in the coming quarters, all of which could impact consumption growth and corporate profitability. Our core scenario for the US growth is a slight deceleration from just over 3% this year to 2.6% in 2019. And bearing a major surge in inflation, there is no reason for the Fed to deviate from its current path of steady rate increases, with another 25% basis points increase in December, followed by 3 rate hikes in 2019. Now, let's hear from Stéphane what this means for investments.
A divided Congress has few immediate portfolio implications. Considering that the fiscal stimulus has created only a temporary boost to growth and likely higher inflation, we believe the dollar is now bound to weaken in the medium term. Higher US risk premia, which arise from the expanding deficit, should also contribute to the currency's softening. Now, while a weaker dollar is positive for emerging currencies, rising dollar funding costs mean that investors must remain selective. Uncertainty over the midterms played a part in October's volatility episode. From now on, the recovery in risk appetite mainly depends on the evolution of financial conditions, especially the evolution of real rates and the trade relationship between the US and China. We remain cautiously optimistic on US equities due to a solid growth outlook that Samy just described. We favor IT software and services, energy, healthcare, and industrials. With inflation on the rise, our portfolio makeup also includes short-duration inflation-linked bonds. The current levels of real rates in the US, albeit higher than at the beginning of the year, are not likely to trigger a bear market, which is why we maintain exposure to risk assets going into the year-end. The US 2020 campaign now kicks off, as the economy starts to slow down after 9 years of growth. With the new balance of power, the odds are high that President Trump will try to reach a compromise with China sooner rather than later. Furthermore, he will likely seek to blame the Democrats for any slowdown in activity. In our next edition, we will present our global views for 2019 and how we position your portfolios to benefit. Thank you very much for watching.